Employment is built on a simple exchange: time for money. You show up, you perform, you deliver output. In return, you receive income. This arrangement feels stable, predictable, structured. But it contains a ceiling. Because time is finite. You have 24 hours in a day. A portion goes to sleep. A portion goes to obligations. What remains becomes marketable. And that remainder defines your earning bandwidth. No matter how skilled you become, no matter how efficient, no matter how valuable your output, your income remains tethered to presence. If you are not there, you are not paid. That is the foundational rule of employment. You can increase your hourly rate, you can negotiate a higher salary, you can earn promotions, but you are still trading segments of your life for compensation. When compensation stops, so does income. This is not exploitation, it is structure. Employers purchase time-bound productivity. They do not purchase your future compounding potential. Your hours generate value. That value often exceeds your compensation. The surplus becomes profit, and profit belongs to ownership. This is where the asymmetry begins. You sell time once. Ownership sells it repeatedly. When you complete a project, you are paid once. If the company scales, ownership continues to benefit. When you work overtime, your income increases temporarily. If the business expands market share, equity holders gain proportionally. Time for the employee is linear. Time for ownership is multiplicative. Linear growth feels productive. Multiplicative growth changes trajectories. In a time-for-money model, your ceiling is biological. You can only work so many hours. You can only sustain so much intensity. Even high-income employees face this constraint. 6 figures still require presence. 7 figures in salary still require accountability to hours and outcomes. The scale may change. The structure does not. When income depends entirely on your hours, time limits you. Every year you age, your energy fluctuates. Every life event interrupts earning capacity. Every pause reduces income. Time works against you because it erodes the one asset you are selling: your availability. This is why retirement planning exists, because eventually, time cannot be sold at the same rate. You are expected to accumulate enough savings to compensate for declining labor capacity. But that accumulation must occur inside the same time-bound model, which means you are racing against biology. Time is not neutral when your income is tied to it. Each hour worked is consumed. It cannot be reused. Each hour not worked is income not earned. This creates pressure to remain employed, pressure to remain productive, pressure to remain competitive. Because once you step out of the system, the income stops. And when income stops, financial momentum stalls. This is the reality most employees never articulate clearly. They feel the pressure, but they describe it as stress, burnout, work-life imbalance. Underneath all of it is a structural truth. When you sell time, you are trading something that cannot compound. Time moves forward regardless, and if income only arrives when time is actively exchanged, time becomes a limiting force. This does not mean employment is wrong. It means it is linear. And linear systems behave differently than compounding ones. Understanding that difference is the first shift, because once you see that your income is tethered to your hours, you begin asking a more important question. What happens to your earnings when you are not working? The promise of employment is progression. Work hard, gain experience, earn raises, and over time your income increases. But progression is not the same as transformation. A raise expands your bandwidth. It does not remove the ceiling. Because the structure remains fixed, you are still exchanging time for compensation. The rate improves. The model does not. Consider how salary growth typically works. Incremental percentage increases, promotions tied to responsibility, bonuses tied to performance metrics. Each improvement is tied to output. Each output requires presence. Even at high levels, executives remain time-bound. They may earn more per hour, but they still trade hours. This creates a hidden constraint. Income can grow only within the limits of the organization. Budgets cap raises. Market rates cap roles. Economic cycles cap expansion. No employee can outgrow the system that pays them. You can climb the ladder, but the ladder has a height. And that height is determined by ownership. Employees negotiate within structure. Owners shape structure. The ceiling becomes more visible over time. Early in a career, growth feels exponential. Entry-level to mid-level jumps feel significant. But as you advance, increments shrink relative to responsibility. Each raise requires more accountability, more oversight, more stress. And still, income remains dependent on continued participation. The fixed income model creates stability, but stability often masks limitation. You know what you will earn next month. You can forecast your salary. You can plan expenses. But you cannot scale infinitely. Scaling requires decoupling income from effort. In a fixed income structure, every dollar has a labor anchor. Every raise has a performance justification. Every bonus has a condition. There is no autonomous growth. Autonomy is the missing variable. Without autonomy, income is reactive. It responds to work. With autonomy, income can expand without proportional effort. The fixed income ceiling also creates psychological comfort. You know your lane. You know your range. Risk feels unnecessary. But comfort has a cost. Because while your income grows incrementally, assets in the broader economy may grow exponentially. Real estate appreciates, equities compound, businesses scale revenue. Those gains are not capped by salary bands. Fixed income grows in steps. Compounding assets grow in curves. Steps feel stable. Curves feel volatile. But over long periods, curves dominate. This is where time begins to work differently. As years pass, salary growth typically slows. Raises plateau. Opportunities narrow. Meanwhile, assets held over the same years may accelerate because compounding rewards duration, not promotion cycles. The ceiling of fixed income becomes clearer with age. Your earning capacity may peak in mid-career. After that, maintaining position becomes priority. This is not failure, it is structural reality. Time amplifies limits in fixed systems. Time amplifies gains in compounding systems. If all of your income depends on a fixed role, you are contained within that role's economics. No matter how disciplined you are, no matter how skilled, that is the ceiling. Understanding this does not require abandoning employment. It requires recognizing its boundaries. Because once you see the boundary clearly, you begin to look beyond it. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, Like the video, subscribe. We'll keep going deeper. Time behaves differently depending on what you own. If you sell time, time is consumed. If you own assets, time is applied. That distinction is structural. In employment, each hour worked is exchanged once. You perform, you are paid, the transaction closes. That hour cannot generate income again. In ownership, the same hour can generate repeated return. If you own equity in a company, revenue growth benefits you whether you are working that day or not. If you hold appreciating assets, value can increase while you sleep. Time compounds ownership. Time depletes labor. Compounding is not dramatic in the short term. It is subtle, almost invisible. A 7% annual return does not feel transformative in year one, but over decades, it becomes exponential. This is the core asymmetry. When income is tied to employment, growth resets annually. You negotiate a raise. You earn incrementally more. The base increases slightly. But compounding builds on itself. Each year's growth becomes the foundation for the next. Ownership allows time to stack. Employment requires time to be resold. Stacking beats reselling. If you save $10,000 from salary and invest it, that capital begins to work independently. The next year, it may earn return. The year after, return on return. You did not work extra hours for that growth. Time did. Meanwhile, your salary remains dependent on renewed performance. If you stop working, salary pauses. If assets continue performing, income continues. This is why retirement accounts exist. They are an attempt to introduce compounding into a labor-based life. But often, exposure begins late, and contributions are constrained by fixed income. The earlier compounding begins, the stronger its effect. Time favors early ownership. Employees often delay ownership because surplus is limited. Expenses rise with income. Lifestyle expands, margin narrows. Compounding exposure remains small. Time cannot compound what is never deployed. That is the quiet cost of remaining purely time-bound. As years pass, energy fluctuates. Career mobility shifts. Market demand changes. Time erodes labor capacity, but it strengthens capital. This is why wealth concentration increases over long periods. Those with assets benefit from duration. Those without rely on continued effort. Effort does not stack the way capital does. You can work hard for 20 years. If income is consumed each year, nothing compounds. If capital is retained and invested, 20 years transforms modest sums into meaningful scale. Time is not neutral. It amplifies structure. In a labor model, time reinforces limits. In an ownership model, time reinforces growth. The same decades pass for everyone, but outcomes diverge based on exposure. This is not about abandoning employment. It is about recognizing that employment alone does not harness time fully. Without ownership, you experience time linearly. With ownership, you experience it exponentially. And exponential systems eventually outpace linear ones. That is not opinion. It is mathematics. If time is moving regardless, the question becomes simple. Is it consuming your earning power or multiplying it? The gap does not appear overnight. It widens gradually. At first, the employee and the owner may look similar. Both earn income, both pay expenses, Both participate in the economy, but time treats them differently. The employee trades hours for compensation. The owner holds an asset that benefits from those hours and from many others. When a company grows revenue, employees may receive raises. Owners receive equity appreciation. When productivity increases, salaries may adjust slightly. Profits can scale significantly. That difference compounds. An employee works 40 hours. They are paid once. The company generates revenue from those 40 hours and reinvests profit. That reinvestment expands operations. More employees, more output, more revenue. Ownership captures expansion. Labor captures wages. Over years, the asymmetry becomes visible. The employee's income grows stepwise. The owner's equity can grow multiplicatively. If the company's valuation doubles, equity holders benefit instantly. Employees must wait for review cycles. One model scales with performance. The other scales with valuation. Valuation can increase without proportional labor increase. This is where time becomes a dividing line. As decades pass, owners accumulate appreciating assets. Employees accumulate experience and savings. Savings do not compound at the same rate as equity ownership. Experience does not generate passive return. And because employees must continually trade time, their financial momentum pauses during interruptions, career gaps, health issues, economic downturns. Ownership often continues through those cycles. Assets do not call in sick. They fluctuate, but they persist. Meanwhile, employees must remain competitive, upskill, adapt, negotiate, all inside a linear model. This creates psychological pressure. You feel urgency to maximize earnings during peak years because you know time will eventually limit you. Owners feel urgency to deploy capital early because they know time will multiply it. Same years, different relationship to time. The asymmetry gap widens quietly, not through exploitation alone, through mathematics. Linear growth cannot outrun exponential growth over long horizons. If you remain exclusively in a linear structure, you remain inside its limits. Even high earners feel this eventually, because no salary scales infinitely. No career trajectory is guaranteed. But equity exposure can scale beyond individual effort. This is why wealth concentrates around ownership, not because employees lack effort, because ownership captures compounding. Time favors repetition. Assets repeat. Labor expires. That is the asymmetry. And once you see it clearly, you begin to question whether all of your time should be sold or whether some of it should be invested into ownership instead. Time will move regardless. The question is not whether it passes. The question is how it works for you. If all of your income depends on selling time, time limits you. If some of your income depends on ownership, time begins to assist you. This is not an argument against employment. Employment provides stability, cash flow, structure. But stability alone does not harness compounding. Compounding requires exposure. Exposure to assets that grow without your constant presence. Equity, index funds, rental property, businesses. Anything that can appreciate or generate return independent of your hours. The shift is not dramatic. It is gradual. You continue working, but you stop relying exclusively on wages. You redirect surplus into ownership. Instead of expanding lifestyle immediately, even modest ownership changes your relationship with time. Because now, part of your financial future is not tied to your calendar. You are no longer selling every hour. you are planting some of them. And planted time compounds. Over years, small allocations can become meaningful. The goal is not to quit your job tomorrow. It is to ensure that time does not work only against you. Because if time erodes your labor capacity and you have no compounding exposure, your financial momentum slows. But if time simultaneously grows assets, your momentum can accelerate even as effort stabilizes. That is the structural shift. Time is not the enemy. Selling it exclusively is the limitation. If this reframed how you see employment and ownership, subscribe for more breakdowns of how leverage changes outcomes. Like this if it helped you see time differently. This channel isn't here to criticize work. It's here to clarify structure. And once you understand how time behaves, you stop letting it limit you and start positioning it to multiply you.